Welcome to Stock Watch with me, Ntaoleng Lechela, and joining me to unpack your stock-related questions today, Sanelisiwe Tofile from All Weather Capital and Thamsanqa Netha from Shiloh Capital. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using the hashtag Stockwatch. Gents, thanks so much for your time this evening. Earnings season slowly picking up. Let's start with the big one. TSMC revenue topping expectations. This comes as no surprise, right, on the back of the AI boom, Tammy.
Yeah, I think when you look at the big data, you see that there's continuously going to be need of improvement. I think it's all about compute and processing, and if you can manage those costs, once you've put in the capex or the cost around that, you are able to then build on top of that. So I think they're going to do well going forward for a while. The only real concern, I think, will be competition and data centers and that kind of stuff. But other than that, I think big data will always be a trend that will do well in the foreseeable future.
Sanelisiwe, Tammy, touching on some of the concerns there, some of the risks at play. Are you perhaps pricing risk when it comes to geopolitical tensions, particularly what's playing out with Taiwan and China?
Yeah, I mean, that kind of noise is always in the background, right? And I think if you look at, someone who likes to speculate might look at what the US has maybe done in terms of Venezuela and start to think maybe China might have the same kind of attitude of becoming emboldened to maybe try to do something with Taiwan, which might increase volatility. And I mean, once or if, let me say, something like that happens, then, the kind of these high valuations of some of these stocks are going to be at a massive risk.
And another note to make there on those big data stocks, those tech stocks, is the spending plans. You touched on that, Taimi, and those big spending plans are one of the reasons investors were rattled last year. We've had those bubble concerns also. That has somewhat died down at this point. Are you still pricing in that risk? Are these counters overvalued?
I think you've got to take a two-pronged approach to it. The first is you've got to recognize that without that compute power and that ability to store data, they won't be able to generate the revenues and the forward-looking projections they have currently. The second approach is to understand that you've got to spend that money to be able to jump exponentially. So you really have to recognize that capex is part of it, and as a commercial exercise, you've got to look at how money is being spent to generate future revenues. And that doesn't necessarily dictate that the stock must necessarily hold its present day valuation, but now has the potential to generate more revenue going forward.
Let's look at the banking stocks. US banks out with earnings over the past few days. Morgan Stanley and Goldman Sachs looking good. Those numbers were out today, Sanelisiwe. And we got numbers from Bank of America, JP Morgan as well. Maybe let's start with what stood out for you there. Any trends to note? Deal making continues to be strong. Investment banking still upbeat as well.
I think if one of the things that kind of stood out to me, I think if you look at the moves from yesterday, I think there was one bank that I think it was, if I'm not mistaken, Wells Fargo maybe having a small wobble there, which kind of put pressure on you in some of the banks' moves. I think one thing that you want to think about with US stocks is that there's a general trend now, let me not say general, but maybe an emerging trend, that the US has been overvalued for a while, the main place to be for a while. And I think any sort of negative news that comes out might see some capital flow out of the US into other markets. So I think this earnings season needs to see, a lot of these sectors or these companies still printing beats and meet expectations. Otherwise, it's the risk here that you see investors start to look at other markets which are perhaps more attractive. So that's the one thing that maybe we need to be kind of mindful of as we look at the US earnings season.
And that rotation somewhat benefiting emerging markets, including the likes of South Africa, Taimi. When looking at SA Inc. stocks, where are you seeing value at the moment?
Well, that's a So that's a difficult thing. The US counters have a lot of access to trading volumes, so their trading income is pretty strong. If you look at Goldman Sachs's trading income, Bank of America is really strong, whereas South African counters don't necessarily have access to that sort of flow from SA consumers. So the capital, the earnings or revenues from South African banks really comes from interest income largely, which is credit, private credit, corporate credit, and credit cards, unsecured lending, and so on. So the growth of that is probably going to be muted given the current consumer's situation, as well as the relatively lower interest rates comparatively. So I think SA Inc. in terms of the banking sector, I think we're not going to really see unless they enter into new product lines, they take certain capital risks, they enter into more funding of private equity, venture capital, and the likes. I don't think we'll see tremendous growth. We'll just see a general ticking along and stability on banking performance. The other sort of broader market that's starting to be addressed is the rest of Africa. So the other banks are really starting to
Yeah.
get into that as a growth market.
And just your take around those SA Inc. stocks, particularly the banks, Sanelisiwe. Those companies have been seen as really, really good companies here in South Africa. I want us to speak about retailers as well, but let's start off what's playing out in the banks. We've been seeing a steady recovery in ABSA and, some flows going into that counter as well.
Yeah, look, I mean, you saw the banks in the last quarter of 2025 coming to the fore. I think this index returned about 18%, if I'm not mistaken. So you are seeing them starting to recover. And I think that move was really on the back of a very strong move in the local government bond yields. So you've seen the compression of the bond yields quite meaningfully last year. And you saw that playing out in the valuations of the banks. It hasn't quite come through to the retailers, which you say we'll touch on in a moment. But the banks are obviously more directly positively impacted by an easing of interest rates. On the one hand, the interest rates being lower might impact their NIMs, which might then impact earnings. But I think the offset there comes in the form of higher credit quality, as the credit delinquencies starts to fall off and then improve the credit losses for the banks. And then obviously a lower kind of bond yield also means that it's a lower discount rate for all equities, including banks. So I think that's kind of what the banks have been responding to, and they've really been probably the one place to hide in terms of SA Inc. because the rest of SA Inc. hasn't really done that well.
And looking at those retailers now, Sanelisiwe, there's a question here on Mr. Price. That counter hasn't been performing really well, and towards the end of the year, we saw it really plunge on the back of its plans to acquire NKD. Your thoughts around that counter and whether investors should be getting into it despite the concerns around that acquisition?
I think the price action in Mr. Price tells you that investors have expressed their concerns around that deal. I think the size of the deal is a concern. 20% of their market cap pre the deal announcement. So the shares fallen quite a bit since then. Their plans around growth in Europe. It's a highly competitive market. You've seen reasonable growth out of the retail, especially the value segment in Europe. But NKD's growth in earnings has been a bit slower than that, which kind of speaks to the competitive nature of that market, and maybe the fact that they were owned by PE or private equity firm, which might have constrained their ability to operate. But also another signaling that is happening with this deal is that what are the management saying about their prospects in SA if they're now starting to look out elsewhere? And obviously the SA is their main operating base. And then the other thing, I think for me, is the fact that they're going to now have to focus management attention on this NKD deal and operation, and maybe drop the ball on the SA operation. And we've seen what other retailers in the past have done when they've gone offshore. and destroyed basically shareholder value when they've done these acquisitions elsewhere.
No,
So
no.
I think investors have expressed their concerns around those things with the price action we've seen in Mr. Price.
Yes, I was about to bring in that bit around what we've seen in terms of M&A activity within the retail sector when, companies do go offshore. Just your thoughts around that before we head into an ad break, Tammy.
Look, I think we haven't done well. So I don't think South African firms have done well whenever we go offshore. I think the second part is who originates these transactions. Is it the management of the company that looks at the deal, or is it a investment banker in one of the large banks who then comes through and suggests these things? Often, when they're suggested by the banker, they don't do well. But when they're suggested by management who've done due diligence research, have gone over there, understood the business and bought it, then I think there's a higher probability of success. So as Sanelisiwe said, the present owner of the business, the exit multiples, as well as who originates these transactions tends to be the downfall of most of our retailers going offshore.
Sanelisiwe, we just spoke about, I guess, a part of the JSE that didn't necessarily perform well over the past year. Precious metals, in the meantime, the miners really rallying over the past year on the back of higher prices. Question here, with prices trending lower today, the viewer asking whether they should buy the dip.
I mean, if you look at where the price move actually finished on the day, it wasn't the biggest dip that you could buy, if we're being honest. But I mean, with commodities, you're always going to experience volatility. I think the difficulty with these shares or even the underlying commodities is that you always have to have your macro hat on, and you always have to zoom out and see the bigger picture. And I think, when you kind of look at where the demand or where the drivers of the commodities have been, a lot of those drivers are still in play. So we had gold being supported by a lot of the geopolitics as a safe haven asset, which then I think is the thing that probably sparked a lot of what has happened in other commodities. The PGMs finally caught up towards the back end, towards the middle and the back end of last year, partly I think as a bit of a substitution from the industrial users of gold, like the jewelry makers who might have been substituting from gold to platinum, given how expensive it was. But also tightening in both the platinum and the palladium markets has resulted in now, various kind of providers and people who look at these things and researchers forecasting that there's some deficits in those markets, which is always going to support the underlying commodity prices. And I think also the fact that now, the GFEX, which is if I'm saying this correctly, Guangzhou exchange, we started now to trade platinum in China. So that's also kind of added further liquidity into the PGM market, and further supporting some of these names. So I think a lot of the drivers are still in play. And then obviously copper is one of the ones probably not spoken too much about, but it's an industrial metal. Spoke about data centers earlier, and general electrification and further infrastructure spend in the world is going to require more copper. So as we see, copper demand still being quite elevated. So a lot of the underlying drivers of these commodities are still in play. So I'm not 100% sure that this is a time to be maybe selling out. But in terms of dips, there's always going to be volatility in the market. So perhaps a time to maybe hold strong for now.
Just sticking with copper there, Tammy, we heard of talks between Rio Tinto and Glencore late last week, where we are seeing consolidation within the sector, particularly on the back of those copper assets. We also had the Anglo Tech deal going through last year. Where does this leave BHP?
They basically have to find their own solution right now. They've got a lot of work to do in terms of competition, and it's going to be tough. I think the upside with copper is that it's standing out as a compelling medium to long-term opportunity. The electrification, grid expansion, EVs, renewables, and that kind of structural demand. Then as well as supply constraints, I think you can work your way through it. I think they really have one or two strategic decisions. One is to look to merge with another global player elsewhere in the world, or too lean out and compete on productivity and volumes. And that always proves to be a difficult thing for a miner because you're largely a price taker. So because you're a price taker, you have to accept that the price given is what is there, and you have to work on your cost and your cost management. So I think they have to enter into a space of strategic decision making, and decide on the way that best suits them to be able to compete.
Tammy, they're alluding to perhaps even more M&A activity within the sector. Sanelisiwe, do you share the same sentiments?
Yeah, I think the constrained supply of the underlying commodity and the operations that are available out there does mean that guys need to find a way to keep producing the metal. And I think you do see that a lot of the operations are in some of these, I'll call them difficult to operate geographies, in Africa, South America, and the likes. And these guys will need to partner with someone in order to kind of unlock those reserves. So I think M&A is going to play a big role here, as well as the underlying demand dynamics.
All right, let's move over to a different sector. A question here, putting up the food retailers against the food producers. So which sector would you want to be in? A Tiger Brands, a Premier, or a ShopRite with, a ShopRite, a Pick n Pay, Woolies that now has their own private label brands as well? Tammy, I'll give that to you.
So as all with all the answers, when you look at stocks and investment, it depends. I think the nature of the quality of the producer. So if you look at the retailers, ShopRite has really done well and is managing to reach its consumers. The Checkers 60 has really been a great success, and they continue to strive for better. Contrary to that, Pick n Pay is really struggling to get itself back to leading. So it'll be difficult to say full blown. If you look at Tiger Brands or you look at any other sort of producer, you might say they look really good, but it all comes down to how they operate and if they are profitable with their operations. I think at this point, companies like ShopRite have proven operational soundness and they return value to shareholders. So you need to look at whenever you look at a sector or a stock, you must look at who is doing the job well and doing it profitably, regardless of how you feel necessarily about producer versus retail.
Let's get your views around that. And I want to maybe just stick to one part of the market. Let's look at the food producers, right? Tiger Brands has been, on a turnaround effort. We're seeing Premier doing really well. They have that acquisition with RFG likely to close pretty soon. Lipster also doing well, but there's talk around takeover there as well. Sanelisiwe.
I assume you directed that at me.
To Sanelisiwe.
Right.
Oh, sorry, you didn't.
It's okay.
Make that clear there. No, I think the food producers have actually done reasonably well in the past kind of while that we're comparing them to retailers. I think the kind of, as you say, the restructuring of Tiger Brands and the soft kind of rebranding is kind of hopefully going to kind of refocus that business. I think the likes of an AVI is always a good operation. They just have to manage, I guess, their input costs being the underlying kind of commodities and the likes, but they've got good brands that always kind of resonate with the consumer. And I think across the board, what actually got quite good management. I think at this level, you really just want to pick your levels here, pick your valuations, and decide on which of the names. But I think they are in a bit of a good space at the moment.
Sanelisiwe, do you see value in Optasia? Question here, is it still a buy at that 21 Rand level? Really had a lot of hype when it listed on the JSE last year with First Rand that is buying into the company as well.
I think for my part, the difficulty in valuing Optasia is that you're not quite sure if it's a tech play with the AI angle or if it's a financial services type of company. So what really blurred the kind of lines for me is trying to find a valuation that meets, where the company comes in. I think a lot of the risks around the current kind of clientele being largely the telcos companies, being quite concentrated, kind of picks its head up for me. So it is a bit of a concern. I think, yeah, at this stage, I'll be kind of sitting on the sidelines on this one because, again, the difficulty of trying to figure out where exactly or how exactly to value this company. It is a new company. Maybe we need to kind of take a wait and see approach here and see how they actually perform and how they actually meet investors and communicate the model and strategy more clearly. And can take it from there. But for now, I think I'm happy to maybe sit on the sidelines.
Are you sitting on the sidelines when it comes to Optasia, Tammy, or even looking at some of the other fintech players on the JSE? You have the likes of a Capital Appreciation. There's your Weaver Fintechs as well.
Yeah, so we have a different approach. We are actually in some of these stocks. Our view is you've got to track this business along the lines of Stripe. Where you have a multifaceted financial services technologies business. You can't, in our view, you can't necessarily separate the financial services from the technology piece. They come together and they offer a unique offering to the market. So we are of the view that if they get it right, they'll be able to enter a very broad sense of the market, and they'll compete with the likes of C in Southeast Asia and Stripe globally. So they call it the total available market is broad given the nature of what they offer.
And just back to you then, Sanelisiwe, on the back of that fintech sector within the country or on the JSE, are there any companies that you like there? I mentioned the Weaver Fintech as well as Capital Appreciation.
Yeah, I think in the local space, there's really a limited a set. I mean, we've spoken about Optasia, and maybe one that's worth mentioning is the Thamsanqa.
Yes.
They've done reasonably well, so I think that's one we actually do like. So maybe that's the one to look at.
Circling back to the clothing retailers, a question here coming. Asking about, let me just get, I think I lost it. Pepkor, yes, Pepkor. What is the outlook for the stock in 2026? And are analysts concerned about the delay we've been seeing in that Pepkor bid for Shoprite's furniture business, Tammy?
So Pepkor is, in our view, it's a race to the bottom. They're trying to go lower and lower down into the market to address that market. And I think they have a strategic advantage over other retailers in that sector. And I think in our view, it's always going to be a difficult thing with that transaction, given that the founder of ShopRite is sitting on the other side with Pepkor as well. So there's going to always be some conflict there. The last time there was an effort to join his businesses, it didn't go well. So it's always going to look like one hand is trying to feed the other. Is it a real valuation? Is it honest? Are you taking off an asset from one side to move it to the other to bolster or to up cash flows on the other? So that dynamic is always going to be at play. But in terms of Pepkor's market and who they address and how all the sort of retailers are trying to reach lower and lower into the market, they've got a big strategic advantage.
All right, let's get into your stock picks, Sanelisiwe. Where are you seeing value at the moment?
Well, we've already touched on this, so my pick for today will be Glencore. We've touched on the copper themes, supporting the underlying commodity and ultimately the company. I think this deal is, we're not sure if it's going to happen or not, but if it does happen, it's actually quite beneficial to Glencore, and obviously combining the two entities will make a larger entity that's even better able to compete. But I think more so on the underlying drivers of copper being the main underlying asset. I think there's good prospects there for Glencore.
And what about you, Tammy? What's your pick today?
Opera Limited, the Norwegian tech company. They have a large reach, especially to the non sort of Apple or call them Apple subscribers. their ability, they are beginning to transform their platform to more digital and AI, enabling more users and more growth. And they are very good dividend yielding stock, about 5 to 6% on average. So we think there's value there.
All right, let's leave it there, gents. Thanks so much for your time and sharing your insights with us this evening. That's all for Stock Watch today. Thanks to our guests, Sanelisiwe Tofile from All Weather Capital and Thamsanqa Netha from Shiloh Capital. Up next, the close.